All right, so Yeti Holdings. First off, I didn't know it was a holding company. Second off, I barely kept in mind that this was publicly traded, so I was immediately intrigued. I've used some of their products before. For those of you that don't know what they do, they make insulated mugs, basically insulated cups that have a layer of foam in between the metal molds to keep your drink warm or hot or cold for an extended period of time. It's marketed as a luxury good, and Yeti Holdings was one of the companies I got immediately interested in because I'm familiar with the product. I find it a little pointless if people want to, hold a mug that keeps their drink cold for 5 hours. But fine, whatever. It's whatever what people want to buy. So a quick look at where it is in the market today. Yeti Holdings at a very rich valuation of 44.4 times EV to EBIT and very high EV to free cash flow. So not cheap by any stretch of the imagination right now. And the market more than likely sees its growth trajectory and can see where it's going as a company and more or less is pricing in the future's growth today, obviously. The 10-year median returns got me immediately interested, not necessarily for an investment. I will not be initiating a position within the next 72 hours, but it did make me curious about the company. So jumping right in, they're incorporated Delaware, corporate offices in Texas, which does not surprise me. They cater to the outdoor leisure market. And the leisure market tends to be, middle class, upper middle class demographic that can afford spending on these kinds of luxury goods, and their stuff is not cheap. By their own mention, they are a growing designer, marketer, retailer, distributor of a variety of innovative branded premium products to a wide-ranging customer base. They built a following of engaged brand loyalists, and you should write that down in your head, brand loyalist, i.e. a sticky customer base throughout the United States, Canada, Australia, and everywhere else, ranging from serious outdoor enthusiasts to people who simply value products of uncompromising quality and design. Founded in 2006 by avid outdoorsmen Roy and Ryan Saters, I don't know, who were frustrated with equipment that could not keep pace with their interests in hunting and fishing. And their original hard cooler not only delivered exceptional performance, it anchored an authentic passion and a durable bond among customers and their company. And their recent developments, they amended their credit facility December 2019, so on and so forth. They opened retail stores in Charleston, South Carolina, and Chicago, Illinois. And in their 10K, they continue on mentioning October and November 2019, they opened a pop-up store in Austin and Dallas, Texas, respectively. They are growing overseas. They launched the Yeti Canada website in June 2019. So that they could buy Yeti products online, obviously the higher margin stuff, and they get to keep a large chunk of their direct-to-consumer sales in their pocket. They are also expanding into the UK and Europe. They launched the website in New Zealand, and they began fulfilling customer orders out of a new distribution facility in Salt Lake City with a global managed by a third-party logistics provider. They repaid the $1.5 million of remaining principal amount for their acquisition of Rambler On. They bought that, I want to say, in 2018. And they continue on with how they're trying to make their products as accessible and as customizable as possible, creating a sticky customer base. They allow for product customization. You can create your own Yeti online, which sounds actually pretty nifty if you're going to pay $50 for an insulated mug. They introduced their Loadout Go box, their Rambler 12-ounce bottle with hot shot cap, and so on and so forth. They're creating a lot of products. You should think right here, R&D immediately. They're pushing as much as possible to continue growing with new products. Now, they have 3 categories: coolers and equipment, drinkware, and other. 2019 net sales of coolers and equipment, drinkware, and other were 40% of their sales in 40% of sales. 58% of sales came from drinkware. 2% came from other. They make hard coolers, soft coolers, storage, transport, and outdoor living. And in 2019, they started making dog bowls. Yeah, a Yeti dog bowl. I don't understand it. I don't. But you know what? If you want to spend your money on that, fine by me. I will judge you in my head. Now, their sales channels, they have a wholesale channel. Their large retailers are Dick's Sporting Goods, Lowe's Home Improvement, REI, Academy Sports and Outdoors, Bass Pro Shops, Ace Hardware, Williams Sonoma. These are middle-class places with discretionary income. You got to think about that the entire time you're reading this kind of company. They aim to people that have discretionary income for, paying for a $40 coffee mug, a $40 cup. Now, they also have their direct-to-consumer channel, and they maintain a large place on their Amazon marketplace. They maintain a large internet presence. And they sell their full line of products at their retail and pop-up stores. In 2019, their largest customer was Dick's Sporting Goods, 15% of gross sales. Yeti authorized on the Amazon marketplace was 13% of their gross sales in 2019. They're very reliant on two places. So immediately, a concentration of receivables risk, so on and so forth. Dick's Sporting Goods isn't really going anywhere. And neither is Amazon, of course. So I'm not concerned about their concentration of receivables, but you still need to know that it is there. It could become a problem if Dick's Sporting Goods closes down again because of COVID-19, and so on and so forth. Right here, I found this a little interesting. As part of their commitment to premium positioning, they maintain supply discipline, consistently enforce their minimum advertised price policy, and primarily sell through one-step distribution. Minimum advertised price policy. It keeps the brand from eroding as people continue to buy their products. They want to maintain creating a luxury brand image. Minimum advertised pricing is going to be the way to go for them to make sure brand erosion does not kick in. And they're also here mentioning on product design and development. They collaborate with their Yeti Ambassadors, a diverse group of men and women throughout the U.S. and select international markets comprised of world-class rodeo cowboys, hunters, anglers, barbecue pitmasters, surfers, and outdoor adventurers who embody the brand, and industry professionals to test their prototypes and provide feedback incorporated into the final product designs. Okay, so they're actively engaging. Basically, I immediately think in my head Instagram influencers when I see this. They want to get their product out as much as possible. And they are actively testing it in a variety of outdoor leisure markets. I mean, I would not have expected barbecue pitmasters, but if it helps make a good product, then hey, why not? Supply chain and quality assurance. Primary raw materials they have are polyethylene, polyurethane foam, stainless steel, polyester fabric, zippers, other plastic materials and coatings. Most of their core products are manufactured in the US, China, and most Asian countries, third-party manufacturing in Mexico, and so on. Their competition, it's not really stiff competition, but honestly, a lot of people can do what they do. It's an insulated coffee mug with an injection of foam in between the metal molds. Who else does this? Igloo, Coleman. Coleman is owned by Newell Brands. The popularity of Yeti products and the Yeti brand has attracted numerous new competitors, including Pelican, Otterbox, Tervis, and Hydro Flask as well. So it's not hard to do what they do, and I will go ahead and point back to the high gross margins here. High gross margins, high ROE, high ROIC attract competition. There's a lot of money to go around here. It's probably cheap for them to make what they make, and they make great profit. So it attracts competition. So I'm not surprised that there's a low barrier to entry here. Therefore, it would keep a price war down. Everybody's probably pricing around the same area for the same product. That's why they're probably focusing so heavily on intellectual property and brand protection. They aggressively pursue and defend their intellectual property rights, so on and so forth. They have a proactive online marketplace, and they're shutting down counterfeit standalone sites for litigation. 790 employees worldwide. They're doing their absolute best to make sure that the brand stays high quality through and through. And that's really the only thing that they can have against Igloo and Coleman, creating a brand image that people are willing to pay up for. And once again, that's their first thing in the risk factor section. product diversion to unauthorized distribution channels, ineffective marketing, negative publicity, product or manufacturing defects. They did have and I will point back to their earnings transcript for Q3, they did have a product recall, a voluntary product recall that I will point to you in their earnings transcript. Oh, excuse me. They did a voluntary recall, and out of an abundance of caution, they had a report of a dislodging of their magnetic lid in one of their products, and they decided to pull the product off of the shelves. They addressed it here. Let's take a moment to address a voluntary recall in partnership with the U.S. Consumer Product Safety Commission of the Rambler 20-ounce travel mug. They launched it in October as their newest travel-ready product. They discovered a potential safety issue, and they decided to take it off. To date, there have been no reports of injuries from customers, but they still had a product recall. They're aggressively watching their new product and making sure the brand image stays luxury. But to still mention that the defect was out there, and they caught it quickly and then moved even quicker. Now, they mentioned themselves they may not be able to effectively manage their growth. They only have a limited history operating their business at its current scale, and their team does not have substantial tenure working together. So they're flying off the seat of their pants to a point, which when you're growing as fast as they are, that's probably the best you can do. They fail to attract new customers, and their growing social media presence is doing their best to aggressively go after new customers. And they mentioned here that they will continue to make significant investments in attracting new customers, growing Yeti Ambassadors, and through social media. They have Yeti Films. This was surprising to me. They are aggressively pushing. I didn't know that they had a Yeti film channel on YouTube. That was pretty intriguing to me. I haven't seen another company like this doing that, but I will say that is very fascinating. Something I'm going to watch out for personally. Just to see how they do it. I'm curious about that. Going on down, and they mentioned here their products are discretionary items for customers. It's not something that they need necessarily, but it is something that you would want. They compete in highly competitive markets, so on and so forth. Rely on third-party manufacturers, manufacturer concentrations. And for their hard coolers, and they mention here, for their hard coolers, soft coolers, drinkware, and bags, their two largest manufacturers comprise 90%, 48%, 81%, and 79% of their production volume during 2019. And for cargo, outdoor living, and pets products, two manufacturers were all of their product manufacturing in 2019. It's very, very concentrated for them, and they have to hope that nothing too terrible happens to their manufacturers. As a result of this concentration in their supply chain, they'd be shot in the foot through and through. They rely on a series of purchase manufacturers for their products. They raise prices in the future, so on and so forth. Okay, nothing too crazy, nothing too special, and that's in this regard. The DTC channel is growing, and it accounted for 42% of their sales. Insolvency or credit problems could expose them, so on and so forth. They are subject to payment-related risks. They did have a lot of indebtedness. They did take care of that. And the fun part before I moved to Q3 2020's 10Q, in connection with their preparation for their consolidated financial statements, they did have a material weakness in their internal financial reporting. And they identified it for the year ended December 30th, 2017. And the material weakness was related to ineffective information tech general controls in the area of user access and program change management over certain IT systems that support their financial reporting process, and failure to properly detect and analyze issues in the accounting system related to inventory valuation. And how do they fix it? They hired a new chief information officer and IT compliance manager. And they implemented remediation activities completed during the fourth quarter of 2019 within their SAP environment and across their IT systems that support their financial reporting process. I'm going to move back to Q3 2020 sales. I'll show you why I'm going to keep a solid look at this company for the foreseeable future. Let's calculate out a little bit of math over here just to show some of the booming sales that they've had during the 2020 pandemic, which is still ongoing, not to act like it's over. For the 3 months ended, I know this is a bit amateurish, but I don't really care. Sales grew 28.5%. Operating income, as you can see, grew well over 100%. And I'll just do the same thing. 106.1% operating income growth, which stopped me a little bit because I looked at this and said, how do they get 106% operating income growth out of 28% growth in net sales? And then I kind of sat down to try to figure out the numbers for what I could. And I'll show the spreadsheet I used. And you'll also see here a massive boost in CFFO, which I immediately wanted to sit down and try to figure out. So I subtracted out amortization of deferred financing fees, stock-based comp, other, because I don't know what it is, I'm just going to take it out. Impairment of long-lived assets, loss on prepayment of debt, and I got to an adjusted free cash flow. I combined all the purchases of tangible and intangible products for capex and called it adjusted capex. I wanted to see how they've been growing because I was interested in incremental EBIT growth. And why I say that is because I wanted to look at if these guys had price power or not. Meaning, can they raise their price and the people will still continue to buy their products? And my answer is I don't know. I do not know if they do. My curiosity to it is that they could, because people will pay up for the luxury brand, quote unquote, experience. However, if you ever walk into like a Dick's Sporting Goods or Lowe's, Home Depot, or Tractor Supply and find their products, they have to offer you a lot to have you make one sale. Now, I don't know how costly it is for them to make it, but judging by the margins that they enjoy having, it's not that expensive for them to make. They're enjoying well over 40% gross margins. So I can't imagine it's too expensive. And they've only been public for so long. So the 2018 and 2019 here, fiscal year 10Ks, I put those numbers there because I still needed a reference point. And the numbers on this section, let me go up, or the first three fiscal quarters for 2020. So what I tried to figure out was what their margins were like, and they've been increasing their gross margins this entire year. Do they have pricing power? Well, that's a great question. They enjoy very large margins, so I would want to say yes, but I don't know. And I would imagine that incremental margin growth shows up in asset turnover, and asset turnover is increasing. ROE for this year has been increasing. ROIC has been increasing, and ROIIC has been increasing as well. So I adjusted for free cash flow and pulled out some of the loss of extinguishment on debt and so on and so forth. And you get these numbers here. And the ROIIC is growing. EBIT incremental margins are growing too, or were growing this for 2020. They release their next 10K very soon. I will imagine next month. So I'm going to do another follow-up video on that. I'm interested to see where this company goes. Clearly, they're making an incredible amount of money on fresh capital that they're putting out there. And as the business grows, I expect them to do the same. That's probably why you're seeing it being valued at 44 times EV to EBIT. The market can see this. It's not the market's not naive. It's not easily fooled either. So I imagine that that incredible growth that the company will be seeing soon will expand rather well, especially when the outdoor leisure market kicks open, when COVID-19 pandemic is fully done and the economic recovery is in place. The outdoor leisure market, I imagine, it is expecting pent-up demand to explode given time. What I would like to see from them, quite honestly, is to see a partnership with some of the RV companies. And I know this is going to get into a little bit of, postulating how easy it is for them to do this. I don't know, but I'll go for it. Why not? I'd be curious to see if they're trying to partner with any of the RV companies to try to expand their market growth or create a new wholesale customer that isn't exporting goods or isn't, Lowe's or Home Depot or REI, and try to work something out with Thor Industries or Winnebago, and I don't know, throw in a Yeti product of their choosing with the purchase of an RV, and really throw the entire outdoor luxury experience into buying an outdoor product like an RV. I would imagine the whole thing is a luxury experience anyway, because the people that can afford an RV and can afford to leave their jobs for whatever amount of time to go traveling on the road like that are affording a luxury experience anyway. That's all the same demographic. I think Yeti has a growing market that they could get into if management, by their own admission, inexperienced at what they're doing at this growth trajectory as is, can figure it out. This is going to be a company that I'm going to follow for the near future. Why? Because once again, EBIT incremental margins have been growing for the past 3 quarters, while capital employed has been dropping a little bit, and free cash flow is still not as bad as I would have thought for a company that's growing. I'm going to eagerly follow ROIIC for this company as much as I possibly can, and pay attention to a lot of their gross margins as well. I'm gonna include all the links, and I'll include the spreadsheet in here as well for your viewership. Please subscribe to the channel. Continue to watch the content. If you like it, recommend a company that you'd like me to run through their 10K for. Create a conversation for this. I would like to know if I could do anything better to make the channel easier for you guys to watch, and so on and so forth. Thank you for watching, and I hope you take care.